Rohr here with an early global view on Tuesday, June 23rd, 2015. It's currently 7 a.m. U.S. Central Time, and it's been, of course, a pretty wild ride out of last week into this week in the equities and the other markets. And quite a bit of that, of course, is still based upon the risk on, risk off influence of the Greek debt dilemma mentality. So, what has all this meant to the markets? Well, you can see the Greek influence out of the top of the week last week when the market was under pressure. And then as we ran into further sense, this is the equities, September S&P 500, hourly on the left, 30-minute on the right. And you can see as that sense of dread wore off once again, having already been, under pressure from the previous week, the market progressively worked its way back above 2090 area, 90 to 92, which was important because this was at an $8 discount to the June contract. So getting above 2092 put the June contract back above 2100, which ultimately, as the June was expiring, going back to last Thursday, the SEP contract actually ratcheted above 2100 as well. But the Greek fears into the weekend put this market back down on a down break below 2106, back below 2100 generally, which is now also an important Fibonacci area, and the old 2096 to 2100 area did manage to hold, though, in spite of the sharpness of the sell-off last Friday, where the market was off something like, $17 or so. It managed to hold back in that range. And we said it's a binary decision. If there was some daylight on Greece coming in this week, market would be good. If it was looking like we're headed for default, this would come under further pressure. Well, the bit of further daylight encouraged a major gap higher opening once again, and yet, in spite of the strength last Thursday, this market stalled up near 2119 to 23, and even on the bit of euphoric activity yesterday, it stalled right up into 2119 to 23 again. We'll see how 2119 was the old historic high that it pushed above a month ago, but then couldn't maintain it. So there's like a false up break and congestion at 2119 to somewhat above it. The most recent down break back on Friday out of the aggressive upward channel since the slowdown here at 2063 was, of course, right up here in the 2106 area. And that's interesting because on trading, that's kind of the bottom of the gap, where the full bottom of the gap is back down into last Friday's 2097.70 close. Works very closely with the 2099 area Fibonacci retracement. So if things look weak again, you still have to allow the first trip back down to 2100 to 2096 is going to be another phase where the bulls might well hold the market in, only back above, actually not even 2123, only back above 2125 or so might this market escape and push through the old lead contract high, which was up at 2132. And as far as the indicators, very important where this market maintains the strength it's showing so far today. It's up about 6 at 2119, and that's because even with the stalling yesterday, the hourly MACD never quite made it out above the upper runaway band, but is parked right there. So it may well be out this morning initially, and then the question will be, can it get through the rest of that resistance on the upside? And going back over to and that pretty much does it for the short-term view of the S&P 500.